Thanks for that very generous introduction. The only thing we forgot is that I'm a recovering investment banker, but hopefully all right, seat belts on, shoulder harnesses good and tight. Let's try to play a little emerging trends. You know, as I think you all know, Emerging Trends is a joint venture between PricewaterhouseCoopers and ULI. It provides an outlook on investment and development, finance, the capital markets, the property sector's location, issues that are affecting the real estate industry. Now we're going to take a test on technology. Excellent. ET is acknowledged as the most highly regarded, widely read, most predictive forecast in the real estate industry. This is the 32nd year that it's been published in the United States. 8 years ago, we started with PwC, a European edition, which has gained a huge amount of traction. And then 5 years ago, we started with an Asia-Pacific edition. So we've really worked to make this a global publication. What makes Emerging Trends so unique is the process we use to gather information that it becomes the basis of the report. It combines one-on-one interviews, and if you look in the back of the book, you'll see a listing of all the people who we interviewed, and it really does read like the who's who of the real estate industry. And online in-print surveys with just a wide array of participants in the industry. And we talked to public and private owners and developers and institutional investors and real estate service providers and advisors and conventional, even securitized lenders. And this year, over 875 people participated in the Emerging Trends information gathering process. So before we look at next year, let's briefly look at where we're coming from. I think almost everyone would agree we've just come through living in a time of more, a lot more, as you'll see. We had bigger cars and more cars and bigger houses with more space and more stuff to go in those houses, and bigger and fancier places to go to be entertained. And we supersized everything, including taking in a lot more calories. And we bought more and more things. And we did more and more deals. And we used more and more credit. Oops, sorry. We used more and more credit. And more leverage as interest rates fell to their lowest levels in memory, and the availability of debt grew geometrically. And we did more deals and we borrowed more money, and it was a great time until all the more exploded into a lot more losses. And this time, the capital markets really couldn't be there to save us. So come join the Emerging Trends team as we enter together the real estate industry's twilight zone, 2011, the era of less. The transition from more to less is going to be very difficult, and it's going to involve getting used to some changes in the industry. We'll have a smaller industry. We'll have lower return expectations. We'll have less development. We'll have reduced availability of credit. We'll have lower profits. And in 2011, many investors and lenders are going to be able to start to recognize losses in their portfolios, because somewhere in the range of 30 to 50% is how much values declined from peak to trough during the recent cycle. Harsh realities aside, the real estate markets are going to come off the bottom in 2011. Interviewees expect improved prospect across all sectors and all markets. If you're a cash-rich investor, you're going to have plenty of options and buying opportunities. Stronger lender balance sheets are going to enable them to start selling more foreclosed properties. And refinancing is going to be available for borrowers with stabilized properties. Better days lie ahead for sure, but one of the things that come with that is a much more rational view of what return expectations should be. The Emerging Trends Buy, Sell, Hold Investment Barometer, one of the most important aspects of the entire report, reflects an improving transaction market. After reaching an all-time low last year and the widest spread between buy and sell outlooks, This year's survey forecasts closing in the spread between the buyer and seller expectations. This changing sentiment is going to lead to an increase in sales as lenders and owners start to dispose of properties and buyers start to dial back their expectations to much more realistic levels from their prior thoughts that they would get an outright steal. As we predicted last year, investors and the lenders focused on the best properties in the strongest markets. And as a result, the deep canyon separates the trophies and the financially troubled assets, with a lot more of the troubled ones in the market today. There's a sharp divide between the have and the many more have-not investors and lenders. The haves have capital and cash flow. The have-nots simply don't. Prices increasing for the most desirable properties, well, it's hard to tell where troubled properties will land because there's so few players who seem to have much interest in them. Investors with capital have many options, and survey respondents see plentiful amounts of capital available to rescue failing borrowers as well as bid on outright sales. But buyers are going to be highly selective, concerned about overpaying. Expect them to continue to shy away from high-risk properties with low chances of recovery and focus on those stronger gateway markets and core properties. The debt side remains a little more of an issue. Lenders' capital positions have clearly strengthened thanks to the regulators who've looked the other way and allowed loans to be extended, major capital infusions from the Federal Reserve, and low interest rates. Money center banks and life insurers now have more money to lend and can be more aggressive on foreclosures and asset sales. But they limit their lending to their strongest borrowers and those with the safest bets and the best relationships. Many undercapitalized regional and local banks continue to struggle. Nearly 300 have failed since the crisis started. People think there's at least another 150 that will fail by the end of 2011. Bankers' doors are starting to reopen, especially for REITs and institutional investors. Lenders are willing to finance purchases in the gateway markets as well as any apartment with a roof on it. But lenders typically want recourse and large down payments, somewhere in the neighborhood of 25% to, we've heard, as much as 50%. Many needing loans are going to have trouble getting a hearing. Of course, any attention is better than what the last 3 years have been like. The debt markets are starting to open, and this trend continues through 2011 and into 2012. Part of that thawing relates to the revival of the previously left for dead commercial mortgage-backed securities market. Conduit teams at the investment banks and the commercial banks regroup. New and more conservatively underwritten transactions come to market. We've now had a number of single borrower and multi-borrower transactions. There are at least 10 firms who are writing and warehousing loans, so CMBS is back, slowly but certainly back. Now the originators and the issuers have gone into lobbying mode, and they're attacking the regulators to make sure that the reserve requirements and the ownership stakes in newly issued securities remain at comfortable levels. There's a lot of confidence in the market that by 2012, CMBS issuance is going to reach the $75 to $100 billion range. We all know the industry is also a little worried about a refinancing problem that stares us in the face, about $300 billion a year for each of the next 5 years. And interviewees suggest that even the outlook for this is starting to improve. Again, if properties have stronger cash flows as well as better capitalized ownership, they've got good prospect for refinancing. Borrowers who can meet debt service obligations will continue to get extensions, maybe dribbled out 1 year at a time, but they'll continue. And if property fundamentals improve, they should be okay. It's another story for people who've got troubled properties. As one borrower said to us, if you have a trophy property, lenders will come after you out of the woodwork. If you have a dog, you can finish that statement yourselves. Defaults and foreclosure rates are going to continue to increase next year because many borrowers are going to finally exit the extend and pretend zone. At a typical market bottom, investors look for big gains, and somebody's going to get some excellent buys during this cycle. But in general, the survey suggests lower overall performance outlooks for 2011 and beyond. Core, private unleveraged real estate is going to show returns around 7.5%, and REITs probably a little bit higher. Overall, this is about where income-oriented real estate should trade on a long-term historical basis. But after losing 30% off peak values, it's going to take some time to make up, that ground that fell out from underneath us. Meanwhile, opportunity funds and investors learned again some costly lessons about investing in real estate. It is very hard to get sustainable 15 to 20% rates of return without a lot more risk and a lot more leverage. Real estate is more about cash flow and keeping buildings leased. So instead of hiring property engineers, instead of hiring financial engineers, they should have hired property engineers. So all in all, we predict more transactions in 2011, an improved availability of capital, and decent performance. The era of less looks a lot better than the last 3 years, but we need to focus on a much larger landscape because that may be what holds us back. As one of our interviewees said, our problems are much bigger than real estate and solutions are well beyond the scope of our industry. What he was talking about was the state of the U.S. economy and America's outsized personal and governmental debt, our persistent high unemployment and stagnating wages, and our lowered consumption and need to save more money. At this point, virtually nobody anticipates a sharp economic rebound. You'd be brain dead if you did, said one interviewee. Optimists point to a U-shaped recovery. Pessimists warn of a double dip. Probably in all reality, we're looking at some sort of reverse J, a sluggish recovery marked by a declining standard of living for many in America. This year, our interviewers repeat over and over again what they've said each year for the past few years. Where are the jobs going to come from? And it's demand, for jobs that drives real estate. But nobody knows where those jobs are coming from. Our interviewees simply don't have an answer, and obviously neither do we. Global competition makes America a high-cost labor market, and thanks to the internet and telecom, we are slowly losing jobs to lower-cost producers. Manufacturing-style job losses now extend to the white collar, as companies need fewer workers and less space. Technology eliminates traditional middle-class jobs, whether those are factory workers or bookkeepers or administrators. State and local governments now, cut workers to balance budgets. All of this adds up to lower demand for office space, reduced buying power in the malls, and reduced buying power in the residential markets. Artificially low interest rates have certainly been a lifeline for many players who realize now that rates have nowhere to go but up. Now survey respondents hope and expect the Federal Reserve will continue to print money, which will allow the reinflation of asset values and help underwater borrowers and lenders. Hard assets, usually like real estate, usually do well during an inflationary environment. Interviewees also worry about a whole group of uncertainties relative to financial industry regulation, the prospects for higher taxes, and the impact of potential reforms on Fannie and Freddie on all phases of the residential market. But really, everyone's concern should be about demand for real estate. Vacancy rates are still at or near record highs, and unless employment starts to pick up and wages start to grow, demand for space is going to rely solely on population growth. So on a per capita basis, that means people in business may not want or may not really be able to afford as much space as they previously used. With demand in the tank, developers have no reason to be particularly optimistic. Pipelines sit relatively empty across all sectors. So in the year and the less, we don't need anything new, or certainly not as much. At least when demand picks up, rents should be able to recover much more quickly because we have a relatively controlled supply versus prior years. So as we shift to the property markets and property sectors, survey trend lines turn the corner across the board, but they're only starting to show marginal improvements, except in those major handful of leading markets. And the gap between investment sentiment between the top markets and the rest continues to widen as investors participate in what we call a flight for quality. So in the upcoming slides, let me review the color codes that we use. Red means stop or bad. Yellow means caution or not so good. And green means go slow or not so bad. The other thing I need to remind you of is that emerging trends is a beauty contest. In a beauty contest, there are normally 3 events. There is swimsuit, evening gown, and talent. But in the emerging trends that you're seeing here, we only have 1 event, and that's swimsuit. So basically what you're hearing is what investors perceive is what they want to do with their money. Okay? It may or may not, agree with any of your beliefs.